How can a giant company make billions of dollars and still pay zero in federal income taxes? That sounds impossible. But for many large corporations, it is completely legal. And sometimes they do not just avoid taxes, they even get money back. This is not usually about secret fraud. It is usually about the tax code. The official corporate tax rate in the US is 21%. But that is not what many big companies actually pay. That 21% is the official rate. What matters in real life is the effective rate. That is the final tax bill after deductions, credits, and loopholes. And for some corporations, that final rate can be very low, sometimes even zero. So how does this happen? Usually through a small set of legal tools. Not one magic trick. A system. Today, we'll look at the main ways corporations lower their tax bills. The key idea is simple. A company can look highly profitable to customers and investors while looking far less profitable to the IRS. That happens because tax rules and business profits do not always use the same logic. So the real question is not, how much money did the company make? The real question is, how much taxable income did the company report? That is where the system begins. First, equipment write-offs. Imagine a company buys a plane, a truck fleet, or expensive factory machines. Normally, that cost would be spread out over many years, a little deduction each year. But tax rules sometimes allow companies to deduct most of that cost right away, sometimes all at once. This is called accelerated depreciation. That creates a huge deduction in the year they buy the equipment. So, even if the company is doing well, its taxable profit can suddenly drop. On paper, it may look like profit disappeared. But in reality, the business may still be strong. This is especially useful for companies that buy lots of expensive assets, like shipping firms, airlines, utilities, and manufacturers. The company is not losing money. It is moving tax deductions forward in time. Second, executive pay. Many large companies do not pay top executives only in cash. They also pay them with stock options. That means the executive can buy company shares later at a lower price. When those options are used, the company can often claim a tax deduction. And sometimes that deduction is very large. In some cases, the tax deduction can be bigger than the expense the company reported to investors. That gap matters because it reduces taxable income. For big tech and stock-heavy companies, this can become a major tax break. The company turns executive compensation into a tax shield. Third, research tax credits. Governments want companies to innovate, so the tax code offers credits for research and development. A tax credit is powerful because it reduces the tax bill directly, not just taxable income. In theory, this supports new inventions and breakthroughs. But in practice, the definition of research can be broad. It is not always just advanced science. It can include product improvements, software changes, or process upgrades. That means many profitable companies can qualify. And when they stack enough credits together, their final tax bill gets much smaller. This is not just a deduction. It is a direct discount on taxes owed. Fourth, offshore profit shifting. This is one of the most famous methods, and one of the most important. Today, many companies do not just sell physical products. Their most valuable assets are often intangible. Things like software, patents, trademarks, and brand names. These assets can be moved on paper. A U.S. company can place those rights inside a foreign subsidiary in a low-tax country. Then the U.S. part of the company pays that foreign subsidiary a royalty fee. So what happens? The U.S. office shows lower profit. The overseas office shows higher profit. But both sides are still part of the same company. This is why it is called profit shifting. The profit is not disappearing. It is being relocated to where taxes are lower. The company does not move the whole business. It often just moves the profit. Fifth, tax havens. Once profits are shifted overseas, the next question is simple. Where do they go? Usually to places with very low tax rates, sometimes near zero. That is why people talk about tax havens. Over the years, companies used complex global structures with famous names. Some loopholes were closed, but the basic strategy remained the same. Move profits through low-tax jurisdictions. Reduce the final global tax bill. The names change. The logic stays the same. When one loophole closes, the system often creates a new path. Sixth, business structure. Not every business stays a traditional corporation. Some businesses organize in ways that avoid the corporate tax layer entirely. This is often called a pass-through structure. In a pass-through, the business itself does not pay corporate income tax. Instead, the profits pass directly to the owners. Then the owners report that income on personal tax returns. That can produce a very different tax outcome, and in some cases, a lower one. So sometimes tax avoidance is not about moving profits. It is about changing the legal box the business sits in. The same business activity can face very different taxes, depending on its legal structure. Now step back and look at the full picture. This is not usually one loophole. It is multiple rules working together. A company might write off equipment, deduct executive stock pay, claim research credits, shift profits offshore, route income through low-tax countries, and choose a favorable legal structure. Each rule may seem separate, but together they create a system. A system where a company can be highly profitable and still report very little taxable income. That is the real reason this keeps happening. Not because corporations ignore the law, but because they use the law exactly as it is written. Corporate tax avoidance works because many small tax breaks can be stacked together. So profits stay real for shareholders, while taxable income shrinks for the government. So when you hear that a giant corporation paid little or no federal income tax, the key question is not whether it made money. The key question is how it used the tax code. Because in the modern economy, taxes are often not just about profit. They are about structure, timing, and legal strategy. And once you see that, the system makes a lot more sense. This is Simplexplain. Complex ideas simply explained.